All right, guys. All right. Hey, I'm excited that you're watching this webinar. What we're going to do today is we're going to do a quick case study. Now, for those of you who have watched any of the videos that we've put out before, you know that we're very keen on having a better system behind everything that you're doing. So today, this system, we're going to put a case study in action showing you buying a piece of real estate. Okay. Now, I'm going to keep this really, really simple and easy. We're not going to evaluate the best type of real estate and how to pay off mortgages and tax deductions and all of that. All we're going to do is we're going to assume buying the real estate only, or buying the exact same piece of real estate plus having it run through a policy instead. Okay, so to keep the numbers really simple, we're going to assume a purchase price of $100,000. And we're going to assume that we buy this property all in cash. Okay, so we've got $100,000 sitting in the bank. We buy that property $100,000 in cash. We're also going to assume that this property appreciates by 3% every single year, and we're going to assume that we can collect $1,000 per month in rent after expenses. Now again, we're going to assume the exact same on both sides, right? So we're going to buy the same property, it's just a better system. So if we bought the piece of real estate by itself and we held that piece of property over a 30-year time frame, let's do some quick math on this. Right, $100,000 purchase price. It appreciates by 3%, and we hold it over 30 years. Okay, so that property at the end of 30 years is valued at $242,726. Okay, the cash flow, if we're collecting $1,000 a month in cash flow from this property, and again, like I said, we're not going to talk about management expenses or anything like that, just a really simple analysis. $1,000 a month times $12,000 a year times 30 years. So $360,000 in cash flow. So 360, we buy this property for $100,000, and our net profit is my calculator back down here. $360,000 in cash flow that we collect, $242,726 in appreciation, minus the $100,000 purchase price, we make $502,726. Okay, so $502,726. All right, so the question that we want to ask ourselves is, can we do this better? Now, for anyone that follows, these webinars that we do, we talk a lot about something that we call the AND asset. And what this really is it's a way to use cash value life insurance to have your money doing more jobs than just a single job. Think about it this way. If I were to come over to your house right now and give you $100, there's really only two options that you have to do with it. You can spend it or you can save it, but you can't do both. That $100,000, when you put it into real estate, it's locked into that real estate and you get whatever benefits the real estate offers. But what if we could take that same $100,000 and put it in a cash value life insurance policy first, and then use the cash value to buy the exact same piece of real estate? So really quickly, let's show you what a policy would look like if we did this. Now, there's some design, ways we have to get money into a policy, so we're not getting it in all at once, but I still designed it pretty aggressively. So what you're going to notice is we're going to take that $100,000 that we were going to use to buy real estate, we're going to put it in a life insurance policy first with two payments of $50,000. At the end, or once we've made this second payment, we've got $87,000 in cash value that we can use. Now, the interesting thing about this cash value, this is the money that we're going to use to buy the real estate, and we're also going to continue to make an interest rate and a dividend on that money even when we haven't, purchased the real estate. There's a whole strategy behind policy loans. I'm not going to go into that in this webinar. If you want to watch that, maybe we'll put a link below this one of how policy loans actually work. But bottom line, this is now the amount of capital that's doing two jobs for you at the same time. So think about this. If you had $87,000 both earning an interest rate and a dividend and in a piece of real estate, do you think we might be better off? Well, let's go through it and prove it out, okay? All right, so let's go back over here to this example. Now, we bought the same property, right, and we held it over the same period of time, so it's going to appreciate the exact same way in both cases, $242,726. Now, the cash flow from the real estate, right, this is the cash flow from the real estate. Over here, we were getting that's a couple of extra zeros. We were getting $1,000 per month for 30 years, and that's what led to this cash flow. Now we're still getting the same $1,000 per month over here, but the difference now is we've taken a policy loan. So the part of this cash flow, we need to pay this policy loan back. And for this example, I'm just going to assume that we do it over 30 years. Now again, I'm not going to show you how policy loans work. I've got other webinars for that. But let's actually go through this. If we take a $100,000 policy loan, in fact, in this example, we're going to have to, let's actually do this one more thing in reverse. We only have $87,000 available in this example, right? So we're going to have to come up with an additional $13,000 out of pocket to buy this piece of property. So let's actually do it this way. $87,000 policy loan. The insurance company is charging us 5% on this, and we're going to pay this back over 30 years, and we're going to do it on a monthly basis. So every single time we get, 360 months. Every single time we get cash flow, the $1,000 a month from this property, we're going to take $465 of that cash flow, and we're going to pay back the policy loan, okay? So let's do the math on that. $465 paying back the policy loan. So what that means is we've got $1,000 a month minus the $465.10. We've got $534 that we get to pocket every single month, right? So that $534, we're going to multiply that by 12. We've got $6,418 of cash flow coming in, times that by 30, $192,000, okay? So again, if you didn't see the math there, the 192 out of that $1,000, we're taking, how much did we say we were taking? Let's bring back up the calculator here. Where are you, calculator? All right, $87,000 policy loan, 5%, 360. We're taking $465. So let's write that right here. $465.10 every month going back to the policy to pay off a policy loan, leaving $1,000 minus 465.1, leaving the rest, 534. Move that, 534.9 as cash flow in our pockets, right? And if we take that and we multiply that, again, 534 times 12, that's what we get on an annual basis over 30 years. That's what we get total cash flow with this case study. So 192,564. All right, so let's finish this out. 192,564. Okay. Now we're still going to have the same $100,000 purchase price. We just put that in a policy first. And if we back off, if we do all the math here, it's going to be kind of easy to see that 242,726 plus 192,564 equals 435 minus the same $100,000, 335,290. Okay, so 335,290. All right, now if we look at this, which one of these two numbers is bigger, right? 502 or 335? Well, if we look at it this way, obviously buying the property in cash only is the better way to do it. But remember, we call this an and asset for a reason, right? In this example, all we're looking at so far is the real estate. We've got to look at what else our money is also doing in addition to the real estate, right? It's also in a policy. So our money is doing two things at the same time. So let's actually look at what this would look like. Now, that policy has some pretty unique advantages to it, right? So here's the advantages that we're going to talk about. Your policy, the cash value inside of a policy, it's earning 5%. That 5%, you earn that whether you take a policy loan or not. Now, as we pay down the policy loan, there is an expense with that, but our cash value never comes out of our policy, which means it continues to compound over this same 30-year period of time. So let's actually take a look at what this will do for our total analysis here. All right, so this is where it gets pretty exciting. So let's go back to our policy here. Remember this $87,000, right? This $87,000, when we use that to buy a piece of real estate, our money's now working in real estate. But that $87,000, we don't stop earning a rate of return on that. In fact, that $87,000, we still continue to earn about 5% on that money. Now, what you'll notice is look at how that money now compounds, right? We're not putting anything else into the policy, and look at this money. It continues to compound and grow every single year. And if we come down here 30 years from now, right, the same time that we were doing the analysis on the piece of real estate, that $87,000, it's turned into $466, plus we still have the real estate, right? So if we come back over here to our case study, right, we could take our cash value in the policy. We're going to put this right here as policy cash value. And what did we say that was? It was 661. So 661. Now, if we look at 661, is that number bigger than this number? Yes, absolutely, right? And if we take the 661, and we add the 335, which is the benefit of buying the real estate, obviously these two numbers are bigger. But let's take it one step further, okay? Now, over this same period of time, this $360,000 of cash flow that we're getting, where is that going if you're a real estate investor? You're probably putting it back into a bank account. It's sitting there waiting for your next acquisition. What if you could take that money and you could put it in a better bank where it's earning a greater rate of return? So let's actually just do a little bit of math here and figure this out, right? Now remember, this $1,000 a month that we're getting cash flow from this piece of property, we're directing $465 of it back to pay off a policy loan over 30 years. Even though we're paying off a policy loan, we're still going to end up with $466. But what if we took this remaining cash flow, this $192 over 30 years, what if we took $534, so let's do the math on this, 534 point, I think that's a 9, and we multiply that by 12, that's $6,418 per year. What if we put that into our policy? How would that $6,418 every single year over 30 years, how would that further compound if it's compounding at 5%? So what you'll notice, this is the exact same policy here now. The same $50,000, the same $87,000 that we're using to buy the real estate here. But now, every single year, as we're getting that cash flow, I'm showing us putting it in this policy. And if we do this over the same 30-year period of time, remember, we were at 466 on the other policy, right? But now, if we're taking this cash flow and putting it in a better bank, now we're at 879. Now, is 879, is that a bigger number, 879, 850? Let's go back over here, 879, 850, right? Now it's not this, it's 879, 850, right? If we take the 335, 290 plus the 879, 850, 1.2 million, I'm just going to round it off, 1.2 million, is 1.2 million bigger than 500,000? Absolutely, it's bigger, right? I mean, that's twice the size, but here's going to be the next exciting part, right? We're going to take this one step further. Obviously, if you can't see how this is beneficial at this point, just flip off the webinar. We don't need to talk about it anymore. But if you want to look at the next aspect, let's take the next aspect, and let's go 20 more years down the road, right? What if you held this property not for 30 years? So in this example, what if we held it for 20 more years, and so we held it for 50 total years, right? Over here, if we take $1,000 a month times 12, and we multiply that by 50, we're going to make $600,000 in total cash flow from this property over this 30-year period of time. Now, what if we still had the same property over here, right? This property over here, this that we've bought, we're still buying the exact same property. And after 30 years, in fact, let's just do it this way. All right, so I'm going to bring up a calculator here. Remember, on the right-hand side, over the 30-year time frame, we used part of that cash flow to pay back the policy loan. Now we're going to talk about us being in retirement, but there is no policy loan. Over the 30 years, we paid back the policy loan, so our original $100,000, it's all paid back. So now, over the next 20 years, we also have that same $1,000 at 12 months. Over the next 20 years, we're earning $240,000 over the next 20 years. Because remember, there's no policy loan outstanding. All right, so $240,000 coming from cash flow from the real estate. But now the real question is, what do we get from this 879, right? Over the next 20 years, can we use this 879 as a source of income? Now, this is where you're going to get blown away. This is pretty exciting. The money that comes out of these policies, it comes back to you tax-free. That's one of the reasons that we use life insurance, is we use it for the tax benefits. So on the next page here, I'm going to actually show us taking income from this policy from age 66 all the way down here to age 85. So a 20-year time frame. So $66,571 per year. This is going to be fun. Let's do this right here. 66,571 times 20. That's $1.3 million in income that we get to take from the life insurance policy, all tax-free. And let's take this back over here to our total analysis. So now we've got $240,000 in income coming from the real estate, and we've got the $1.3 million of income coming from our policy. So 240, that's $1.5 million in income. $1.5 million in income versus 600. Well, I guess it's not even that. I mean, we'll just keep it there for that. We're in this example, let's make it even. Let's make it even better, right? Because over here we're assuming cash flow over 50 years. Over here I was only assuming cash flow over 20 years. So let's bounce this back down here as well. You get the point, right? All this is you're getting a higher rate of return. You're getting more use out of your money. In fact, how much more use out of your money? Let's just take it one step further. This is just too fun. All right, so I'm going to pull up a rate calculator, and we're going to look from a rate of return difference. What is the difference between $600,000 in total income and $1.5 million in total income? That's a 150% increase in income. So if you could have a better system and do the exact same thing that you're doing right now, but have a 150% increase in efficiency over the income that you're going to get, would you not take that every single time? I know I would. I know I do. This is the strategy that I use every single day. This is the strategy that Jimmy and Bob use every single day. So if you're watching this video, this is likely something that you will want to do in your real estate investing as well. So there it is. Have a great day.